Imagine you're reading a financial report, right? And you see that the world's largest banks are just posting these record-shattering
Right,
profits.
just massive numbers.
Yeah. And at the exact same time, AI companies are spending, I think it was $500 billion in a single year.
At least half a trillion, yeah.
But then you keep reading, and the stock market is bleeding. Healthcare as a sector is actively shrinking. And the Federal Reserve is, well, publicly warning everyone to just stay on high alert.
It's wild. It is the absolute definition of a macroeconomic paradox.
It really is. Welcome to July 2026, everyone.
Yeah, we are looking at a market where, the surface level headlines are just completely disconnected from the actual structural realities operating underneath.
And that is exactly why we're here. Welcome to the deep dive.
Glad to be diving in.
Whether you're, managing your own portfolio, maybe prepping for a major strategy meeting, or if you just want to possess a genuine understanding of the current economy, we've got you covered.
Absolutely.
Today's mission is ambitious, but I think it's essential.
Yeah.
We've pulled from a massive stack of July 2026 reports. We're synthesizing data from FactSet Earnings Insight, Goldman Sachs, the U.S. Energy Information Administration, PNC Economics, and honestly, a bunch of global market trackers.
It's a literal mountain of institutional data. But, there is a distinct verifiable narrative hidden beneath all of that conflicting noise.
Right. And our structure for today is pretty straightforward, but we aren't just going to sit here and read you a table of contents.
No, definitely not.
We are going to break down this economy sector by sector. We want to discover the actual mechanisms driving these numbers.
Yeah, the why behind the what.
Exactly. And then at the end, we'll provide a clear summary of each area, along with a general overview of what this incredibly complex landscape means for you.
So to truly understand the chaos at the top of the market, we really have to start at the bedrock, right?
The bedrock, yep. The macro picture and the financial sector.
Because you just cannot understand tech valuations or, say, energy volatility without first understanding the cost of money. And that is entirely dictated by inflation and interest rates.
Okay, so let's look at the latest FactSet Earnings Insight. If you just read the top line, things look incredibly rosy.
Oh, they look fantastic on the surface.
Right. Second quarter earnings for 2026 are booming. The blended S&P 500 earnings growth rate is sitting at a massive 24.7%.
Which is huge.
It is. And if that holds through the end of the reporting season, it marks the second straight quarter of earnings growth above 20%.
Yeah.
And the biggest driver of this surge, it's actually not tech. It is the financials.
The scale of the banking beats right now is, it's frankly staggering. It is completely reshaping market expectations across the board.
Look at the big players. JP Morgan Chase didn't just beat expectations. They posted nearly $7.70 a share.
Wow.
And Wall Street was modeling mid-fives.
Yeah, that's a massive gap.
And Goldman Sachs was even wilder. They reported an astonishing $20.98 per share against an expectation of $14.54.
Right. And we should point out, these aren't rounding errors. These are profits roughly 30 to 40% higher than what the brightest minds in finance were predicting.
So why? Why are the banks suddenly printing money at this unprecedented scale?
Well, it comes down to a historically unique macro environment. Specifically, we have to look at what we are seeing in the yield curve.
Okay.
According to street stats, we currently have a normalized upward sloping yield curve. So the 10-year Treasury is yielding 4.60%, while the 2-year is at 4.23%.
Right, so that's a positive 37 basis point spread.
Exactly. Now, in previous cycles, a spread like that might just be business as usual, nothing to write home about.
Sure.
But in this specific historical context, coming out of a prolonged period of inversion and zero interest rate policy, it is an absolute goldmine for financial institutions.
Right, because they aren't just capturing that basic spread between short-term borrowing and long-term lending. They're capturing it at significantly higher absolute rates.
Precisely. It's a completely different margin profile. But that 37 basis point spread signals something much broader for the economy, too.
What do you mean?
It means term premiums have returned. Investors are actively demanding higher compensation to lock up their capital for a decade, basically because they genuinely believe the economy will continue growing. The long end of the curve is being supported by resilient, tangible growth.
Okay, let's unpack this, because this is where the macroeconomic picture gets deeply confusing for me.
Fair enough.
The yield curve says growth is resilient, right? And typically, hot growth triggers higher inflation.
Traditionally, yes.
But inflation is actually cooling off. PNC Economics just dropped a report on the June Consumer Price Index, and the numbers are undeniably soft.
They really are.
Core CPI actually fell by 0.02% for the month, and headline CPI dropped 0.42%.
That is a remarkable contraction. And the underlying mechanisms driving it are fascinating. The weakness we are seeing is just incredibly broad-based.
Yeah.
Look at core goods, for example, which includes highly tariff-sensitive items like imported furniture and apparel.
Right, the stuff that usually spikes.
Exactly. That category actually contracted at a 0.7% annualized pace over the last 3 months.
And it isn't just imported goods either. Even super core inflation, which is services excluding shelter, and we know the Fed completely obsesses over that metric, that fell 0.1%.
Yep, a very important drop.
And a huge mechanism driving that was a sudden 2% drop in auto insurance premiums.
Which nobody was really expecting.
Now, and on top of that, shelter inflation, which is the undisputed heavyweight of the CPI basket, slowed to just 0.12%. And that was primarily because hotel and lodging prices fell pretty sharply.
Yeah, so all of this data feeds directly into the Federal Open Market Committee meeting scheduled for July 28th and 29th.
Under Chairman Kevin Warsh.
Right. So with rates currently parked at 3.5 to 3.75%, and with this cooling CPI data in hand, the Fed is widely expected to remain patient.
Meaning they don't need to hike?
Exactly. They don't need to hike. And the European Central Bank is looking at a very similar dynamic, actually. They're expected to hold their deposit rate steady at 2.25%.
Okay, but I have to push back on this optimism, though.
Go for it.
If inflation is structurally cooling, and if economic growth is resilient, and if banks are raking in these historic profits, why is Kevin Warsh being so defensive?
That is the million-dollar question.
Right. He is publicly urging investors to completely ignore forward guidance. He's telling the market to only track incoming, real-time data and explicitly warning that authorities won't tolerate continued inflation.
Yeah, his tone has been very striking.
Is the Fed basically driving with the emergency brake on? Like, is Warsh terrified because he knows the wind is about to shift?
That is an excellent way to conceptualize it. If we connect this to the bigger picture, the macro environment is incredibly fragile right now, precisely because it is priced for perfection.
Right.
The controlled burn is working today. But central bankers know that one specific external shock could reignite the inflationary underbrush overnight.
Wow.
And if that happens, they are forced to hike rates aggressively rather than holding them, which would, instantly destroy those banking profits and the whole growth narrative we just outlined.
Which means central banks are basically walking a tightrope. And there is one massive, highly unpredictable force that could snap the line entirely.
Oh, absolutely.
Let's look at global energy.
The ultimate external shock. Energy is the wild card dictating the survival of this entire economic recovery.
And it is completely defying the broader market narrative right now. FactSet is projecting the energy sector to post the highest year-over-year earnings growth of any sector in the entire market.
It's massive.
A staggering 124.8%. Yeah. And the mechanism behind that is pure math, right? The average price of oil in Q2 2026 was $92.55.
Yeah.
That is up 45% from $63.68 just a year ago.
And that kind of price action is rarely driven by organic supply and demand. It is almost entirely driven by geopolitical conflict.
Right, because we've seen these escalating hostilities that have put a severe squeeze on commercial shipping traffic through the Strait of Hormuz.
Exactly.
And because that physical choke point is under threat, Brent crude jumped nearly 16% recently, bringing it to near $88 a barrel. West Texas Intermediate, or WTI crude, jumped 14% just this week.
The Strait of Hormuz is the quintessential bottleneck. I mean, when millions of barrels of daily transit are threatened, the market price is in catastrophic supply failure instantly.
But wait, this is where the data completely diverges from reality.
Oh, totally.
The U.S. Energy Information Administration, the EIA, they just released their July short-term energy outlook, and they are painting a fundamentally different picture here.
Yeah, a much calmer picture.
They noted that the U.S. and Iran actually signed a Memorandum of Understanding, an MOU, back on June 18th to formally end the conflict and keep the strait open.
Yes, and if you look at the EIA's internal models, they are weighting that diplomatic development very heavily.
Exactly. Because of this signed MOU, The EIA expects global oil inventories to fall by only 2.2 million barrels per day in the third quarter.
Which is manageable.
Right. That is a fraction of the 7 million barrel deficit the market was terrified of just weeks ago.
Yeah.
The EIA is actually projecting that Brent will drop to an average of $74 in Q3 and steadily decline to $65 by 2027. They even predict U.S. retail gasoline will drop to around $3.40 by the end of this year.
That's a huge divergence from current prices.
Right, so here's my question. If a historic peace deal was signed in June, why in the world are we seeing spot oil prices spike 14 to 16% in mid-July? Are traders just acting irrationally?
It is an irrationality, actually. It is a fundamental difference in how financial markets measure risk compared to government agencies.
Okay, how so?
Markets price in immediate tail risks faster than they price in diplomatic paperwork. A memorandum is just a promise, right? But a threatened strait is a physical reality.
That makes sense.
Think about the mechanics of shipping. A tanker requires massive insurance premiums to transit a conflict zone. If hostilities flare up, even briefly, insurance providers do not care about a June MOU.
Not at all.
They hike premiums today, or they just refuse coverage entirely.
Which essentially creates a localized blockade, regardless of what the politicians actually agreed to on paper.
Precisely. The spot market is trading on the immediate fear that the 60-day negotiation window built into that MOU might fail.
Wow.
Long-term models like the EIA, they assume the peace holds and supply normalizes. But financial markets operate in the present, creating this extreme real-time volatility in the energy sector that threatens that delicate macroeconomic balance we discussed earlier.
So we have the bedrock of high interest rates, perfectly balanced against cooling inflation, but constantly threatened by highly volatile energy costs.
It's quite the high wire act.
It really is.
Yeah.
And this high wire act brings us directly to the biggest spender in the entire global economy. Let's talk about technology and AI.
The undisputed heavyweight. I mean, this is the sector that has been carrying the broader S&P 500 on its back for over 2 years now.
And if you just look at the raw earnings numbers, the tech narrative seems basically invincible.
Oh, for sure.
FactSet shows the information technology sector with the second highest earnings growth at 63.4%. And within that umbrella, the semiconductors industry is up an unbelievable 131%.
It's just astonishing top-line and bottom-line growth on paper.
But despite those massive numbers, the sector is actively bleeding on the trading floor.
Yeah.
The NASDAQ 100 recently dropped 4.1%. The Philadelphia Semiconductor Index, the SOX, tumbled 10% in a single week and has officially entered a technical bear market. I mean, it's down over 20% from its peak.
Right.
I struggle to understand this. Why is Wall Street actively punishing companies that are legitimately posting 131% growth?
The answer lies in 2 words, really. CapEx jitters.
Capital expenditure.
Exactly. Goldman Sachs just published a pivotal report detailing the massive infrastructure build-out required to sustain this AI boom.
Okay.
The consensus estimate for 2026 capital expenditure by AI hyperscalers, the massive cloud and tech titans, has climbed to $527 billion.
That is just, wow.
Alphabet alone just raised its 2026 CapEx guidance to a range of $180 to $190 billion.
$500 billion in a single year across the sector, and that money isn't free anymore, what we talked about.
That is the exact mechanism causing the panic. In a zero interest rate environment, the market might applaud $500 billion in spending.
They'd love it.
Sure, but at a 4.6% yield environment, the hurdle rate for profitability on those data centers is massively higher.
Right.
Goldman notes that because of this debt-funded CapEx, a violent divergence has occurred. Historically, all AI stocks basically moved in unison, but recently, the stock correlation among these hyperscalers dropped from 80% down to just 20%.
Here's where it gets really interesting, because it sounds like the market is finally tired of paying exorbitant debt-fueled prices for the shovels, and now they are aggressively demanding to see the actual gold.
That is the perfect way to visualize the mechanics of this rotation. Investors are actively segmenting the market now.
Okay.
They are moving away from the infrastructure builders, the companies funding these massive data centers with expensive debt, and they're rotating into what we call AI platform stocks and productivity beneficiaries.
Meaning they only want companies that can categorically prove AI is generating real revenue today or significantly lowering their operational labor costs.
Exactly.
They want hard proof of return on investment, not just a glossy presentation about future capabilities.
And what's fascinating here is the historical context Goldman Sachs provides to ground these numbers.
What did they find?
Well, $500 billion sounds like an insurmountable peak of spending, right?
Yeah, that sounds like the top.
But even at $527 billion, AI CapEx only represents about 0.8% of U.S. GDP.
Oh, wow.
If you look back at the late 90s telecom investment cycle, to match that peak relative to GDP, these AI hyperscalers would actually need to spend $700 billion in 2026.
$700 billion. Wow. So the infrastructure spending might not even be close to its peak, but investor patience is already snapping.
Yeah, the tension is very real.
The sheer scale of that capital requirement is just staggering. And, while tech burns through cash trying to build the future, there is one major sector that is completely freezing over in the present.
Yeah.
Let's look at healthcare.
It serves as a very stark reminder that a rising macroeconomic pie does not lift every boat.
Not at all.
Well,
According to FactSet, healthcare is the absolute lagging outlier right now. It is the only sector out of all 11 reporting a year-over-year decline in earnings.
the only one.
Earnings are down 18.2%. Their net profit margin has shrunk to 6.3%, down from 8.1% just last year. I really need to understand the mechanics here.
Sure.
With all the medical and biotech innovation we see in the headlines, why is the business of healthcare actively moving backward?
It connects directly back to the macroeconomic bedrock we established at the beginning. High interest rates always claim a casualty.
Always.
Healthcare research, development, and facility management, it's incredibly capital intensive. When borrowing costs stay high for a prolonged period and localized inflation drives up operational costs like, nursing wages and medical supplies, healthcare facilities just get squeezed.
Because they can't just hike their prices the next morning to cover the spread.
Exactly. The regulatory lag is severe in healthcare. A hospital negotiates reimbursement rates with Medicare or private insurers years in advance through these incredibly rigid contracts.
Oh, no.
So if their operational costs spike 10% today, they cannot legally pass those costs on to consumers quickly. They simply have to eat the loss.
Wow.
Their margins compress. It basically proves that a higher for longer rate environment has real structural victims.
So what does this all mean? Let's zoom out and fulfill the specific mission of today's deep dive.
Let's do it.
We've looked at the underlying mechanics of 4 wildly different sectors. Now, let's summarize each one and build an actionable framework for you, the listener, so you can actually use this data.
Let's run through the synthesis. First, financials. They are the current bedrock of market strength, thriving on a unique historical environment of stable, high interest rates and cooling inflation.
Right.
As long as that upward-sloping yield curve remains intact, the banking sector continues to print money.
Second, we have energy, the volatile disruptor. They're pulling in massive profits right now, entirely due to geopolitical conflict and physical threats to supply chains.
Yeah, totally externally driven.
But they are staring down a potential massive price drop if diplomatic deals like the U.S.-Iran MOU actually translate into safe physical shipping routes.
Third is technology and AI, the heavyweight sector that is currently going through a severe reality check. Yes, they are posting massive growth, but investors are demanding actual return on investment for their $500 billion CapEx bills.
Show me the money.
Exactly. The market is actively punishing the infrastructure builders and rewarding the proven revenue generators.
And finally, healthcare, the lagging outlier. They are structurally trapped by shrinking margins in a high-cost environment, completely unable to pass costs along due to regulatory constraints. They are the living proof that a 4.6% yield environment isn't good for everyone.
Which brings us to the general overview of the global economy. Currently, the S&P 500 has a forward PE ratio of 20.3.
Okay.
That valuation is significantly above both the 5-year and 10-year historical averages.
Meaning, broadly speaking, the stock market is highly valued. If you are managing a portfolio or a business strategy right now, the takeaway isn't to blindly run away from tech or dive headfirst into banks.
No, definitely not.
It is recognizing that we are firmly in a show-me market. Companies can no longer survive on the mere promise of future growth because the market is priced for absolute perfection.
Precisely. The global economy is proving to be incredibly resilient, but it is currently holding its collective breath. We are balancing on the absolute knife's edge of Middle Eastern geopolitics dictating our inflation reality and the unproven promises of AI revenue dictating our stock market valuations.
It is a phenomenal balancing act. But before we wrap up, there is one final critical connection hiding in this data that we actually haven't touched on yet?
Yeah, this raises an important question, something we really want to leave you to mull over on your own. We talked about Goldman Sachs noting that AI hyperscalers might eventually need to ramp up their capex to a staggering $700 billion just to match the 90s telecom boom.
Right.
Think about the physical mechanics of that. The infrastructure required, the actual concrete data centers, the massive liquid cooling systems will be entirely unprecedented in human history.
The sheer scale of building required is almost impossible to fully comprehend.
So consider this. Could the ultimate long-term winner of the AI tech race actually end up being the energy sector?
Oh, wow.
Simply because of the mind-boggling sheer amount of physical power that will be required to keep all of those new data centers running.
That's a great point.
If the tech sector cannot sustain its physical build-out without massive, reliable energy consumption, the disruptor might just end up eating the heavyweight.
Now, that is a thought that flips the entire board upside down. The most valuable shovels in the AI gold rush might not be the microchips at all. The shovels might literally be the electrical power grid itself.
Something to think about.
Thank you so much for joining us on this deep dive. The data today is dense, and the market headlines are constantly contradicting each other, but hopefully we've helped illuminate the mechanics operating just beneath the surface. Keep questioning those headlines, keep looking for the why beneath the raw numbers, and we'll see you next time.